Hello and welcome to More Than Commas. I'm one of your hosts sometimes, Cory Shepherd, and here with me today is Trent Trailov, a friend of ours in the tax planning industry. He's the CEO of Trail CPA, and really excited to have him here. We're recording in our various offices, but he's actually the closest guest to me here in Chicago that we've ever had on the podcast. So Trent, great to have you here today.
Thank you so much, Cory. Pleasure to be here.
Yeah, it's fun to connect. You know, we first met in Seattle, hadn't talked for a while, and then we got back in touch and realized we lived within an hour's drive of each other in the Chicagoland area. It was really fun. But that actually speaks to how your business is a little different than folks might think of in a CPA practice, just like ours is in Sound Financial Group, spread across some areas. So could you just introduce folks to Trail CPA and how you've set up the business and who you work with?
Absolutely. Yeah, sure thing. So we're also a virtual firm. I consider us hybrid. We have physical locations in Kirkland, Phoenix, now in suburbs of Chicago, and then also in Pittsburgh. So a lot of clients in those demographics and have the option to come into the office and meet in person, but most of our clients work with us on a virtual basis. We do video calls. We have a secure upload portal, calendars in our emails to get a hold of us timely. So yeah, we've gone the same direction as Sound has.
Cool. And I think just one thing I noticed when we were emailing back and forth, like you have something in your subject line, if your email to the tune of like, we're bringing on staff and we can definitely take on new clients, which sometimes in different CPA firms, like folks I've noticed have had a hard time finding new help when they're looking for it. So can you're like available for this upcoming tax season for folks that are looking for that help across a wide range of different planning issues?
We are. Yeah, we have capacity. We are planning on bringing on many clients before tax season, which is upcoming. I think our advantage of having a virtual firm and being able to hire outside of just Kirkland, Washington is a big advantage. Opens up the pool of CPAs and EAs that we can hire and work with. And being virtual for so long, we've got the kinks out. We've got that figured out. A lot of credit to my business partner, Jeremy, for building a lot of that process for a virtual firm and continuing to hire the right people.
Yeah, cool. Well, I'm really excited to pick your brain today on something that we were talking about that I think a lot of our clients would be interested in, which is this QBI deduction. And I'm going to let you define it for a second, but that's, qualified business income. So that we're talking to folks that have non-W-2 income in addition to their W-2. So that's just my high level for perking someone's ears up. And there are some ins and outs of who can take how much, but it's a really powerful tool. And we're going to look at some examples that I'm excited about. Can you just kind of give the high level of QBI, who can take it, who should be careful about taking it, and then we'll dig into some numbers to show some examples.
Yeah, I mean, I think you defined it pretty well. Self-employed is going to be eligible for qualified business income deduction. Came about in the 2016 tax changes. The headline was more the corporate tax changes going from 35% to 21%. The non-corporates, sole proprietorships, LLCs, S-corps, partnerships, 10-member LLCs, they received qualified business income deduction as a tax break. And so that's up to 20% of the profit of the business in the form of a deduction. And so the example I'd like to use is $100,000 of profit. You could be eligible for a $20,000 deduction. And then what we're going to be talking about today is specified service trades or businesses and the limitations on income and some strategies to help navigate those limits and open up the QBI deduction that you may have not received otherwise.
Cool. So let's I'm going to share my screen and take a look at a couple of examples. We have a couple of examples here to look at how this might apply to someone. And I first want to look just at look at the tax rates and the phase outs. I know you have this information straight from the IRS. I took it in a format I could find easily online. So I just say that for everyone, like we don't just Google things randomly and pull whatever else came off, but these were like kind of prettier versions to look at. So let's talk about the phase outs first on who can use this and when they have to be careful on income ranges for this deduction.
Yeah. Sure thing. Yeah. So for a single filer, the phase out is going to start at 197,300, and that phases to 0,300. For joint filers, it's essentially double, meaning the beginning is going to be 394,600, and instead of a $50,000 phase out, it's a $100,000 phase out. So you're fully phased out at 494,600 of taxable income. And taxable income is an important piece to QBI because a lot of these phase outs in tax are related to your adjusted gross income. And this QBI is unique in that it's based off taxable income, which opens up some more strategies that we can talk about to qualify.
Yeah. And so that's the really important piece, is that over that 494, so if we're saying married filing jointly, if you're over that 494,000, spending some money in your business in a tax deductible way can bring you down below to actually qualify for this deduction in a way that you wouldn't. And that's what we're going to look at in our examples here.
This episode of More Than Commas is brought to you by Sound Financial Group, where we help families and business owners build and protect wealth through clear, long-term financial strategies. Whether it's retirement planning, investment management, or navigating your overall financial strategy, we're here to help guide you every step of the way. To learn more about how we can help you secure your financial future, visit sfgway.com. You can run retirement calculations and download content to read in your own time.
So this first example is W-2 income of 195,000, K-1 income of 300,600. And so what I put together here as an idea, and I'd love, you're double checking this along the way to make sure I did my spreadsheet right, but 101,000 of deductible expense, like someone's thinking, oh, should I buy that next piece of equipment or truck that helps me make more deliveries, whatever that investment is in the business. If you're over the taxable gross income of that $495,000 threshold, spending that $101,000 now gets you into the QBI eligible world. So taxable gross income now becomes $394,600. K1 becomes just under $200,000. And so the QBI deduction, and this is where folks, I think, can round up too much. They say, oh, I can take 20% of my income that I get, I get to save that in taxes, but you save the taxes that would have owed in your tax bracket. So that's where we have 24% taxes saved on 20% of your qualified business income. And then you also save the money that was going to be in that 32% bracket up above that threshold. So on 101,000 of spend in the business, you actually get to save 41,900. So 41% on the, 41% off on investing in your business if you were right above that threshold and you weren't going to spend that money anyway. Like, this is, we were talking about, this is so huge to me, as like, this is one of the areas where I think the tax code works really well to encourage something, which is investing in the business. Like, the idea is you could pay that extra tax or spend the money on your business and maybe make more money in the future, but which is good for the economy, and then save it now. Like, that makes so much sense to me. Now, who has to be careful as far as a type of business that can take this above this threshold or not? Because, like, explain to folks that, like, sure, someone's listening to this right now thinking, like, a financial advisor is probably listening to this thinking, oh my gosh, I can just go crazy on this. And I think there's a reason why financial advisors are in this group that can't take as much of this deduction, because we would be like to the ends of the earth trying to figure out ways to take this. Like, that's why they start to limit it for us.
Sure. So it's really consulting businesses. So the big ones that stick out is attorneys, lawyers, financial advisors, CPAs, and then really any business where it's the reputation and the skill of the owner that is how you're generating income. And so those
like
are
a doctor that was a solopreneur would also be in that case, probably, like their knowledge and expertise, like they're running their own practice.
Correct.
Yeah. Yeah.
And so it's a pretty broad definition. There is some good tax law around what is an SSTB as far as profession and what is not. And so that's part of our job to help you determine that. And if you're checking the box for an specified service trade or business or not. And so we're helping our clients navigate that. But very broadly speaking, it's the consulting businesses. It's not the retail businesses. It's not the manufacturing businesses. And so depending how strong the lobbying is for that profession, we'll see if you qualify or not. But in this example, we're talking about a business that is an SSTB. So those professions and more the consulting and service-based businesses. If you're not an SSTB, just real quick on that, there is no limit. There is no phase out based off income. There are limitations though based off the either 50% of your W-2 or 25% of your total W-2 paying out all your employees and 2.5% of your business property. We're focusing a little bit more in this conversation on the service side of things, but for those non-service businesses, there are some limitations on QBI and definitely some strategy. So I just wanted to put that out there too.
Right. So it's really a very small subset that you could think of yourself as a consultant of some kind. Like I would be a financial advisor. It's a financial consultant. You're a tax consultant. Like they have to think about this threshold. So if you own a manufacturing company, you don't care about the thresholds and the
not
way
the income thresholds. No,
this.
there's some other rules that you have to navigate, and we help clients there too. Yeah, think a coffee shop, restaurant. So
right, and that's a good point. Like if someone is not sure if they have to care about these thresholds or if they qualified as an SSTB, and like you'll help them make the case on their and defend that decision if you think they should be on the line and don't need to worry about these thresholds. Like that's part of what you're doing in that tax planning.
Correct.
Yeah, that's great. So we have a second example. It's a little bit different, which is instead of a business expense, a charitable contribution. So same W-2 and K-1 income. And why I think this one's super cool is that one, having charitable proclivities, wanting to give back to the community, support your church or a different organization. Wonderful. And that's why that's written into the tax code is the government wants to incentivize that activity too, because that's good for all of us. And in this case, it's a bigger total savings. Can you talk about why we're actually saving even more giving the same amount of money?
Yeah. So in the example that we have an expense on your business, you're actually lowering the profit on your business, thus lowering the amount that is eligible for qualified business income deduction. So the savings on the QBI deduction in this example is lesser, even though the bracket savings is the same. So if you're taking a deduction outside the business through a charitable contribution, you could do that through tax loss harvesting. You could do that through itemization. Those are ways to do it on your 1040 essentially. And
right,
you have a little higher QBI deduction and tax savings there.
And so, it's thinking about the different kinds of income we're earning, and that by taking this business expense deduction, you're actually qualifying for the threshold if you were over it, but also you have less that you get to save in that QBI deduction. So the charitable contribution is cool as long as you're inside of some other limits that, again, Trent would help you figure out if this is cash, you can deduct more of it. If it's securities, you may have a different limit. So relative to your overall income, there's always another thing to think about. But then you actually get to go into under the QBI threshold and have more of the QBI deduction to take, which is why your QBI savings are higher. And then you've got your same bracket savings. So you get a little bit more for that. Now, we've been looking at, with the higher standard deductions on tax returns for folks that aren't itemizing, we've been talking to folks about things like a donor advised fund where they could make more of a contribution in 1 year to stack like a couple years of contributions into one tax year and get up above that threshold. So there's a few other things that might come into play on that. Are there some other ways that you've thought about, like we give these two examples just to show folks how they work, but what are some other ways you've thought with folks about like either taking finding money to get under the threshold? Like what are some other strategies you've used?
Yeah, so the tax loss harvesting is one. So if you've got a fair amount of gains and you typically have gains in your investment portfolio, harvesting losses to get your taxable income down and qualify for QBI is another way to do it. And sometimes it's a combination of a bunch of these strategies so that we can get down either in the phase out range or below. Itemized deductions, so that's going to be mortgage interest, property tax. They just made some tax law changes to your state and local taxes. So the limit actually got pushed up to $40,000. Now, like you said about charitable contributions, there's limits, income limits on that as well, but that could come into play, and itemization could be a route to go. Medical is in there. Investment interest, mortgage interest, charitable contributions are in there. Retirement is a big one too. So especially self-employed, retirement contributions to bring your taxable income down, depending if you have IRA, simple, SEP, solo 401k, regular 401k, defined benefits plan is another way to do it, even through W-2. So if you have a spouse, of course, with QBI, you have to have some business ownership. So we know that's part of the equation, but maybe your spouse has a W-2 and, well, maybe we do some HSA contributions. Maybe we do some 401k contributions over there. And that would also lower your taxable income on your 1040 to get you within range. So those are definitely come to mind. You already talked about business asset purchases, expenses on the business, maybe prepaying for a marketing package, maybe prepaying your rent for your office, just to get in range and really maximize that. On the other side of things,
that's a funny one. I love that. Like, what vendor or landlord is going to say no to getting some extra money sooner? But maybe if it's the first quarter of the year and you're prepaying just to get down below that threshold, as we've seen, if you're above the threshold and you need to care about that, it's not a lot of money sometimes to get a big savings. That could be a nice rate of return on prepaying rent and make someone else really happy to start the year.
Yeah, it is funny, right? Yeah, a landlord would typically be very happy about that. On the other side, being careful of Roth conversions, which would push up your taxable income. Right. As a business owner, perhaps deferring income as far as when you actually receive it. That could be something it's kind of the other side of expenses, if that's an option. Home sales too. So if you've sold a home and you actually have some taxable gain on that, that could push up your taxable income. So there may be some strategy to consider there as well.
Yeah. So really I guess the moral of this is if you're going down this road trying to pay attention to this deduction and maximize it, it's on the income and both sides of the ledger. You've got to think about tuning that so that you're hitting that right amount. Again, if you're a business that needs to pay attention to these thresholds. And again, I think you put it, like we talked about before, accountants, financial advisors, consultants. To me, I'm always thinking about what is the IRS thinking about with every regulation. And it's like, well, the very people that are most likely to want to pay attention and optimize this for themselves, they're kind of cutting off if like, hey, you're going to take a lot of advantage of this because you're thinking about it all the time. So like we have to take care of those, pay attention to those thresholds. So anything else that we've missed about kind of what's important for folks to think about on this deduction, or just for folks to think about going into 2026 that you'd love to share with folks?
I think it starts with knowing if you are an SSTB or not. And a lot of it can be easy depending on your profession, and then some maybe not so much. But I think it's a great place to start to build a strategy around if QBI and implementing some of these strategies makes sense. Just in general, new tax law changes in July. So a lot of new fun updates for us to navigate and work in. And I think I already mentioned the SALT change there. No tax on tips. Well, there is a payroll tax, and there are limitations on that based on income and how much you can take. Overtime, there's a lot of new stuff there. So maybe we could do a topic on the new.
I was going to say.
But if not, even just looking up some information, there's some great educational material on that new bill. And for those who are self-filing, it's good to know the current tax law.
Well, maybe a lot of reasons to not be surprised if you see Trent coming back on the podcast in the not too distant future, because there's a lot of things to talk about for the coming year and all these developments. Trent, thanks again for coming on. Really appreciate you taking the time. And for everyone listening, if you know someone who's got a side hustle, got another business, owns their own business, has some non-W-2 income, please use the buttons below, share it with someone this could help. Like and subscribe to keep getting updates for the channel. And as always, now get on back to living a great life. Thanks for listening.